Okay, so today we're going to go through chapter 6, continue for merchandise inventory. As we said from last class, for chapter 6, we just quickly go through 3 different methods to count for the value of the ending inventory and cost of goods sold. It's gonna be not a long session today. Then when we finish chapter 6, I want to quickly go through our final exam. Then you can have well prepared for that. Okay. So first of all, from option 1, are there different methods used to account for perpetual inventory? Yes. So first of all, I want to quickly review the 2 different inventory systems. The first is a perpetual inventory system. The second is a periodic, right? We're going to talk about the perpetual inventory system is the importance of inventory to merchandising companies, right? And there are also some key terms we have learned from last class. There are ending inventory, the cost of goods sold, the gross margin, and unit costs. And also we need to, for perpetual inventory system, we need to maintain a continuous record for each inventory item. The quantity and cost of the inventory on hand can be determined. And account cost of goods sold is debit when inventory is sold, and therefore is shown as one amount on the income statements. So we quickly take a look at this slide. Ending inventory equals the number of units on hand times the unit costs. The cost of goods sold equals the number of units sold times the unit cost. I think there is examples we can quickly see. Okay, so let's imagine there's 3-month period where the boxes of tea were purchased. Now the tea, how much for the tea? The first month we spent $55 for each box. Second month we purchased as $60 per box. The third month we spent $65 for each month. Now what is the cost of each unit left in inventory after some of the tea is sold? Okay, so we have to quickly think about it. So for each month, for the 3 months in a row, we purchase the new boxes of the tea, right? During your purchase, you probably sold it during the purchase. See, first month we purchased 55, and end of the first month probably we sold few of it. And then the second month we start purchase $6 for each boxes, a few more boxes for second month, and then we start sell a little bit during the second month, end of the second month, and the third month. Now the question is asking, what is the cost of each unit left in inventory? So this is why we need to talk about 3 different methods. It depends. So the answer is it depends. It depends on what costing method is used. The 3 different cost methods we under ASEP is, first of all, specific unit cost or specific identification. Second is the weighted average cost, and third is first in, first out. So we're going to talk about each detail. First off, the specific unit cost, which we also call a specific identification method. This method assigns a specific invoice price to each specific item in the inventory. Okay, so we will quickly see the examples. So if product A assigned $10 for each, product B assigned $5 for each. So whenever they sell it, the price has no change because it is coordinated with a specific unit. And first in, first out. First in, first out is cost of goods sold based on the oldest purchase. So whenever the product come in as earliest, it's always sell first. Okay, so coming first, sell first. Weighted average. Weighted average is the examples I was giving. So first month, second month, third month, there's coming and they come out. Every time when there's a new purchase, we need to recalculate the average cost for the period. There are going to be examples to explain for each of it. Now this one, it shows in our textbook. Wait a second, I think some of the students sent me an email. Oh. Now we're waiting for Kelsey to join in. Okay, there you go. So keep going with our lectures. So this one you can see from our textbook. It gives you a very good example to show the 3 different methods. Now each product is identified except for the price per box. So we could see that this is a T box, right? So there are 2 white T box, 1 red one, 4 yellow, 2 blue. So you can see for a white T box is $1 for each. Right? Red one is $2 for each. And yellow one is $4, $3 for each, and then $4 each for the blue one. So we sell 5 units, then carefully identify which ones were shipped. So we shipped 1 blue, 2 yellow, 1 white, 1 red. Because we know that how much for each of the specific item, then we should know the cost of goods sold equals to 1 times 1, 1 times 2 yellow, 2 times 3 yellow, and 1 times 1 white and red, and 1 times 1 blue, so which is $4. The total cost of goods sold equals to $13. Then the ending inventory is easy to see. We have 1 white, so 1 times 1, 2 yellow, 2 times 3, 1 blue, right? 1 times 4. So the ending inventory will be $11. So this is for specific identification method. Now we'll move on to the FIFO, so which is first in, first out. So it's still the same. We have $24, the boxes available in the storage. Now we need to sell 5 boxes. Now because the white one coming first, and then the red, and then the yellow, and then the blue. So we have to let the 2 white go first. So 2 times 1. The red has to go for a second. So 1 times 2. And then 2 yellows go the third. So 2 times 3. Then our cost of goods sold will be $10. Now the left, how much is the ending inventory? We use the calculation with 2 times 2 yellow, 2 times 2 blue. Okay, so that is the first in, first out method, which means the first to come in always sell first. Now the third is the weighted average method. Weighted average method, as we mentioned before, is every time if there's a new purchase coming, you need to recalculate the average price. But for this example, there's no coming. There's no new coming, no new purchase. So we just sell as what it is. As we already know that the available, the total will be $24, because we know that is right here. We have all the cost available $24. Now we need to calculate the weighted average price, which we use $24 divided by 9 box. 1, 2, 3, 4, 5, 6, 7, 8, 9. So there are 9 box. We use 24 divided by 9, which is $2.67 each box. Now then we sell 5 cases. We simply use 5 times the average cost, which is $2.67. So the total cost of goods sold will be $13.35. And then the ending inventory will be 4 times $2.67 equals $10.68. Now, so be careful for this examples because there's there's no new purchase in. So that's why we do not need to always recalculate the average cost, which is simply use the average cost at the very beginning. Now we're gonna see the examples that will have more complicated situation. Here is an example. Inventory costing in perpetuity system. Now the inventory costing method produce different amount for any inventory cost of goods sold, as we can see. Even though there is a new purchase in, we could see the cost of goods sold under weighted average will be $13.35. Under FIFO will be $10. Under specific method will be $13. So you can see there's always different cost of goods sold. So it totally depends on the company, which method they use, right? Now the examples we're gonna see is gonna have a new change coming, new purchase coming. Now November 1st, which is beginning inventory is 10 units, with the average cost, the unit cost is $10 for each box. November the 5th, we purchased 60 boxes more with $11 per box. Then November the 15th, we sell 30 boxes. And then November 26th, we have another new purchase, 70 boxes with $12 per box. And then the end of November 30th, we sell 90 boxes. Now the selling price is $25 per gift box. That is no change. No matter what different method you use, $20 per gift box, no change. Now we're gonna see this. The specific method we're not going to use for this examples, as you know, the specific is just give you a specific price, right, for a different product. But for this one, there's no specific method. We're going to see in general. So we're going to see first in, first out method, and then the weighted average method. Now, first of all, we're going to see the first in, first out. There is a tables. When you need to do a questions like this, you could just simply use this template to the calculation. So we have purchase, we have cost of goods sold, we have inventory on hand. November 1st is our beginning inventory. We have 10 units with $10. So our total beginning inventory is 100. Now November the 5th, we purchased 60 boxes more with $11. Then our total purchase will be 660. Okay, so when we add $100 plus the 660, this is $760 will be after the first purchase. Now we're going to sell 30 boxes. Because the first in, first out method had been used, we have to sell the first 10 boxes, and because it's the oldest coming, right? It's the oldest. It's already in our storage. So we sell 10 boxes with $10 per each. And then 20 boxes out of the 60 times $11. So the total cost of goods sold will be 100 plus 220. Okay. Then how much left in our inventory, which is inventory on hand? Now we sell 30, we have total 70, so we have 40 left. What is this 40 boxes? Those 40 boxes is coming from the 60 boxes, right, with $11 per each. Then our total inventory on hand after the first sale will be $440. Now, November 26th, we purchased 70 boxes more with $12 per box, which the total cost is $840. Then the total box we have is 110 boxes, Then end of November, we're going to sell 90 boxes. So the first 40 boxes coming from that 60 boxes when we purchased from November the 5th, we're going to sell first. Okay, so we use 40 times $11 with 440. Then another 50 boxes coming from the second purchase, 70 boxes. Okay, so we use 50 times 12 boxes equals to 600. Because it's 11 and it's 110. Divide 90 boxes, we have 20 boxes left on hand. So we use 20 boxes times the $12 per box. The 240 is going to be our ending inventory balance for November. Okay, so our total cost of goods sold, we'll add it up for the two sales. Okay, our total purchase will be $1,500. That makes sense. That is our first in, first out method. Now, so the first in, first method, which is simply summarized in here, 120 units. That cost of total 1,360. 1,360. And then the ending inventory 20 units. The cost total is 240. So the ending inventory will be 240. Now use the familiar cost of goods sold model to check the accuracy of the inventory record. With beginning inventory, we have 100, right? With 10 units at 10. We have net purchase. The first purchase 60 units with at $11, and then the second purchase 70 units at $12. So cost of goods available for sale will be 1,600. And then last the ending inventory, you have 20 boxes at 12. It's already in here, 240. the cost of goods sold will be 1,360. Okay, so this is just match the tables we just made. I just simply give a format so you can see. Now, FIFO journal entry, we don't need to go this like one-on-one because you already know that. Simply you purchase inventory on account, we debit inventory credit account payable. Then we sell on an account, we use debit account receivable credit sales revenue. You know, remember always if you sell inventory, there's always two journal entries, right? So we have debit cost of goods sold become expenses and credit inventory. And then November 26th, we purchased another 70 box. So we debit inventory credit account payable. 30th, we sell 90 box with debit account receivable credit sales revenue. In the same time, because we sell the inventory, we have to record the cost of goods sold as expenses. So we debit cost of goods sold credit inventory. That is all for the FIFO method. Any questions on that? Good. Okay, so after FIFO, when they move on to the weighted average cost method. The weighted average cost method, as we just talked about it, the business compute a new weighted average cost per unit after each purchase. Now, the ending inventory cost of goods sold are then based on the same most recent weighted average cost per unit. So we can see the examples, the same examples, but use the different methodology. Now, so November 1st, we have 10 units left. That is our beginning inventory balance times $10 for each box. Total beginning inventory 100. November the 5th, we purchased 60 boxes more at $11. So our total cost will be $660. Okay. Then we can see from here, our total cost will be 100 plus 660. So total cost will be 760. We divide 70 boxes. Right, from 60 boxes purchased in and 10 boxes left in our beginning inventory balance. So divide by 70, our boxes per weighted average will be $10.86 per box. So that is our average cost per box is $10.86. Okay, so this is the number we're going to use if we have sell after November the 5th. So November 15th. We sell 30 boxes. We use 30 times this average cost equals 326. How much we left in our box? We have 40 boxes left. We still use that weighted average cost is $10.86 equals this 434. Okay, so that is our inventory on hand after the first sale. Now we keep going. We purchased $60 boxes more at $12 per box, which is 840. We use 840 plus the 434. That is our inventory on hand. It divide by 110 box, right? 40 left plus 70 more, so it's 110. We use 434 plus 840 divide 110 box equals $11.58. So our average cost of the average cost per unit increased right after the second purchase. That becomes $11.58. So we're going to sell 90 boxes on November the 30th. We use this $11.58 as our cost per unit. So that equals to the total cost of $1,042. Then we add those two in, the cost of goods sold total will be 1,368. Do you see that? It's a little bit more than the FIFO method, right? And that the ending inventory will be there 20 boxes times $11.58 is 232 in our ending inventory. So that is the weighted average method. And the funny thing is, you can see comparing the FIFO and the weighted average. The weighted average is higher cost of goods sold and lower inventory on hand. Right? That was 240 under FIFO and 1,360 under FIFO. So we're gonna do a comparison after this. Now, so this is the moving weighted average cost method. The examples it's giving is we just made a calculation for the first new purchase in, we have to recalculate the cost per unit. That is 100 plus 660 and divide by 70 boxes. So the average cost per unit is $10.86. Okay. Now, after you finish the calculation, we need to do a journal entries. Now the journal entries, the same thing. We debit inventory, credit, accounts payable. That is the first purchase. November 15th, we sell 30 boxes. So I have account receivable and sales revenue. In the meantime, we have to do another journal entry to record the cost of goods sold expenses. Okay. Then we have purchase inventory on account, 70 boxes. Then we sell on the November 30th for another 90 boxes. So exactly the same journal entries. The only difference is every time there's a new purchase, we have to recalculate the average cost of unit. So that is the weighted average method. Any questions so far? No? Good. Okay, then we'll keep going. So the next, we're going to count what are the effects of two of the different methods. We just quickly did a comparison, right? So the two different methods create different financial results. We could see the cost of goods sold under the FIFO is 1,360. Under the weighted average 1,368. So which leaves our gross margin. Gross margin is higher under FIFO and lower under moving weighted average. So it depends on the different business. Which kind of method will more benefit of the business, right? As we said that the sales revenue is the same value, so $3,000 for two different methods. Well, now when inventory costs are increasing, FIFO costing produce the lower cost of goods sold. Remember the first beginning inventory is $10 per box. And then November 5th, the first purchase is $11 per box. And then the November 15th, it goes to $12 per box, which means that the costing, the inventory costs are increasing, right? So during that situation, FIFO will produce the lower cost of goods sold and higher gross margin. However, if that inventory costs are decreasing, so for example, if in this question, the beginning inventory will be $13 per box, and then the first purchase will be $12 per box, and then the second purchase will be $10 per box, then that means the inventory costs are decreasing, and the cost will produce the lower cost of goods sold and higher gross margin and higher net income. So it depends on the situation. Okay. The situations we'll be using this examples just quickly just remember that so you could have a good understanding. Just for this, the examples we went through is when the inventory costs are increasing, a FIFO is more beneficial on that situation. If the inventory costs are decreasing, the moving weighted average is more beneficial for the business. Okay. So that is the comparison of the two different methods. Actually, that is one of the most important topics you need to pay attention on because you will see the different methodology questions in your final exams. And make sure that you understand those two different methods, the FIFO and weighted average. Now, the third topic we're going to talk about are the different methods used to account for periodic inventory. Periodic inventory, the FIFO method and the weighted average are much easier under periodic, as we know that periodic system is where the business does not keep a continual record of the inventory on hand. So we're not just tracking how much purchased, how much left on hand. right? And there's physical count of the quantity of inventory. We always made at the end of the period. The unit cost is applied to this quantity, and the result is the inventory figures that appears on the balance sheet. And the periodic system is used for items that have low unit costs. The example being used last class was the box of beans, right? So there's inexpensive items that is we normally apply the periodic system. Now we quickly see the cost end of the period. Cost of goods sold must be calculated for the income statements. Now the FIFO, we're going to see the exact. I think there is examples for the FIFO. How to use the exact the same. So you can see that under periodic first in first out method, exactly the same situations. Beginning inventory 10 units, $10. New purchase 60 boxes, $11, and then we sell 30 boxes. And then the 26, we purchase 70 units, $12, and then we sell November 30th, 90 box. And the revenues have no change. It's $20 per gift box. Now under periodic, there's only one journal entry you need to make, right? Because there's no physical counted or there's no tracking during the period. So we simply just debit accounts receivable, credit, sales revenue. Because the first sell, we sell 30 boxes, right? November the 15th. So there's 30 boxes with times $25 per box. Now, when we're tracking the cost of goods sold, we have our beginning inventory, 10 units at 10. New purchase, 60 units, 11, 70 units at 12. So it's going to be total $1,500. Then when last the ending inventory, we have 20 units at $12. So exactly the same. Then our cost of goods sold will be 1,360. That's exactly like the FIFO we used under periodic. The only difference is the fewer journal entries in the periodic system. Now, weighted average costs, we use the same data in the periodic system, right? Because we're not tracking the continuing change of the quantity of the product. So the simply we use cost of goods sold available for sale. That is how to calculate it. Okay, cost of goods available for sale. We use 1,600 divided by 140 units. 140 units, we use 10 at the beginning, 60 first purchase, 70 the second purchase. So total units will be 140. So it's 1,600 divided by 140 units. The average cost per unit for the entire period is $11.43. You are not going to see the short answer questions for the periodic system. The only question you will see will be the perpetuity, because periodic is just much easier than the one we just went through. Now, quickly under weighted average cost periodic, we have beginning inventory 100, which is unit at 10. New purchase, 60 unit, 11, 70 unit, 12. So there's no change until the cost of goods available for sale. The only difference is we do the calculation, we use 1,600 divided by 140 units. So the weighted average cost per boxes will be $11.43, right? Then we have left 20 units left at $11.43. So the total ending inventory will be 229. Cost of goods sold will be 1,371. Actually, it's higher than the FIFO method, right? FIFO is 1,360. So weighted average cost method is higher than the FIFO. If the same thing, if the inventory price goes up. So that is all for the two different methods under two different inventory system. Any questions on that? Nope. Okay. Now, then we move on to apply accounting concepts to inventory. I'm not going to go through all this in detail, just quickly go through this. If you're interested, you're definitely going to you can go back to your textbook and just read them through, okay? Now, the several accounting principles related to inventory. First of all, the consistency. The consistency principle states that business should use the same accounting method and procedures from period to period, because it helps the investors to compare the results from year to year. Because you do not want a big company just use one, like say perpetual inventory system on year one, and then year two they change to periodic, right? So that is consistent principle saying that companies must report any changes in the accounting method they use under the financial statements under the notes. And they suggest the business should use the same accounting method from period to period. The disclosure principles. The disclosure principles requires companies to report enough information for considers to make knowledgeable decisions. We know that sometimes you see a financial statements probably is pretty simple. There are only numbers in there, but when you open their notes or footnotes, you could see there are a lot of notes going on under the financial statements because they need to explain all the numbers coming from, especially for cumulative amortization. They should state it like for what kind of assets or capitals has been amortized during how long period. So those are kind of a detailed information. Or if the company decide to use periodic, they have to indicate in their notes and saying why they use the periodic system for the year. Okay. So this is what it shows in their slides. The method used to value inventory or different category for inventory. Okay. Materiality. This is kind of account streams to state that a company must perform strictly proper accounting only for items and transactions that will influence the decision making. Therefore, if something would not influence the decision making for external users, then it's just too small and does not have to be recorded in strict compliance with the asset. For example, transportation costs, right? Or we talk about this as freight, and they can be expensed if it's not material. So if it's not a big costs or gonna affect the decision maker's decision, then do not have to be considered or influenced. Accounting conservatism. Conservatism in accounting means to present the financial statement at an amount that leads to the most cautious immediate result when more than one possibilities exist. Now, this is if in doubt, record an asset at the lowest reasonable amount and a liability at the highest reasonable amount. Or when there is a question and record expenses rather than the assets. So that is kind of goal. So this is kind of is to provide a reliable statements that do not want it to mislead the external users, that the results are better than they are. So you can see from this one, if there is a doubt, if there's a question, right, we always record expenses rather than assets. Other inventory issues. In addition to choose between the FIFO weighted average method for inventory, we also encountered some inventory issues. One is the lower cost net realized value rules. We're going to talk about this. And also their effect of inventory errors or ethical issues or estimating any inventory. Now the lower cost and net realized value rule. So pay attention to this one because I got students have questions regarding it. It is a rule, right? The inventory, that means that the lower of its historical cost and its net realized value. So the inventory is reported when comparing those two. One, historical cost, two, net realized value. If the net realizable value falls below the historical cost, the business must write down the value of its inventory. It happens. Remember, what can I consider good examples? So just simply for examples, like the tea boxes we just had for FIFO and weighted average cost, right? For example, if the tea box selling $25 for the Christmas time, but the cost for the per tea box was $30. So you can see that the $20, it goes down $5, right? If this situations happened, we have to write down the value of the inventory. We'll see examples together. Now, the net realizable value, how are you going to calculate that? We use selling price, deduct the selling costs. So that is our net realizable value. Now, Blend Tea paid $66,000 for Christmas Blend Tea inventory on September 26th. By December the 31st, the seasonal inventory can only be sold for $4,000. For example, COVID, people are not buying the Christmas Blend Tea gift box, so which leads the cost, the total values of the tea boxes decreased $2,000. And this is the decline in value appeared permanently. It's because it's permanently, then we need to write down the inventory, comparing the costs and then the net realizable value. Now, because there is a $500 advertisement costing, so we need to deduct that $500. Now, the total cost was, historical cost was $6,000. Right, the net realizable value, we use selling price, 4,000, deduct the advertisement cost, 500. So which is 350, no, yeah, 3,500. So $3,500 is the net realizable value. We use 6,000, deduct the net realizable value of 3,500, which gives to the inventory we need to record the write down of the inventory total value is $2,500. That is how the $2,500 is coming from. 6,000 deduct, 4,000 deduct, 500. Okay, then we need to write down the inventory. Remember the inventory shrinkage. When we meet the inventory shrinkage from the last chapter, it's exactly the same journals, right? We realize the cost of goods sold expenses and write down the inventory. So exactly, if the lower cost and net realizable value has been applied to one of the situation, the same journal entries will be applied. We debit cost of goods sold, credit inventory. Okay, so this is how you're going to write down if there's if the situations happen. Now the arrows, effect of inventory arrows. Arrows in ending inventory affects not only the balance of inventory, but also cost of goods sold, gross margin, net income, owner's equity in the period that the arrow occurred. So the examples we have given is from our textbook. The inventory, this exhibit, it shows an inventory arrows. They summarize the arrows on 2 different periods. So we could see if the inventory arrows overstated, see the ending inventory is overstated on the first period of the inventory statements, then the cost of goods sold will be understated. Because the cost of goods sold understated, our gross margin will be overstated. And then our net income will be overstated. So that is what we talk about. The arrows in the ending inventory will affect not only the balance of inventory, but also the cost of goods sold, gross margin, and net income. And then the inventory arrows goes to the second period, will be reversed in second period, and has the opposite effect on cost of goods, gross margin, and net income. So you can see if on the first period of the inventory recording has been overstated, goes to the second period, the ending inventory will be understated, and the cost of goods will be overstated, gross margin will be understated, and net income will be understated. So this is how the arrows will affect 2 periods. This is kind of a comparison between the 2 different comparisons, okay? Conflict issues. Because the impact of inventory arrows some unethical managers maybe tend to overstate the ending inventory, as we said in there. If it's overstated, the gross margin and net income will look much better in the statements, right? So some of the ethical issues will be the managers will be overstated ending inventory of their financial statements, and then to make their gross margin and net income looks beautiful, looks better in the financial situation of the company. So that is kind of ethical issues because really closely related with a inventory errors. Now the next one, how can we estimate inventory if there is a fire? So you pay attention to this. I think we have a detailed examples in our textbook for if there is a inventory on fire, how are you going to do the calculations? We'll see all together. Now we used to estimate inventory in case of like destroyed or there's a fires, right? Or to prepare a monthly financial statement without completing a fiscal count. The method used the company's normal gross margin percentage to estimate the cost of goods sold. What is the gross margin percentage? Remember, how are you going to calculate the gross margin? We use total revenue, deduct cost of goods sold. That is our gross margin. If we use that gross margin divided by total revenue, that is our gross margin percentage. Okay. So let's see the examples. Well, beginning inventory, $20. New purchase, $100. Cost of goods sold, $120. Ending inventory, minus $40. Cost of goods sold, $80. Now, the examples we're showing the gross margin method of estimating inventory. We use our beginning inventory, 14,000, and then new purchase, 66,000. Cost of goods available for sale, add those two up, is 80,000. Okay. Now we need to estimate the cost of goods sold. We have sales revenue. This is given $100,000. Gross margin percentage is 40%, which means total revenue deduct the cost of goods sold divided by total revenue equals the 40%. Now, so if you need to do the calculation of cost of goods sold, how are you do it? We use 100,000 deduct 40% times 100,000, right? So that is the cost of goods sold. But just for this example, simply to remember it, if they give you gross margin of 40%, then the estimate cost of goods sold will be 60%. That is 1 minus 40%. Okay. So whenever they give you gross margin percentage numbers and give you the sales revenue, then you could easily to calculate the ending inventory, estimate the cost of ending inventory. This is the formula. Remember it or memorize it because you're going to use this one to calculate one of the questions in your final exam. That is, it will give you all the information and ask you to calculate the ending cost of ending inventory. Okay. Question?
I have one.
Yeah.
So what if the question doesn't give us the percentage for what do you call it? Yeah. So what if it doesn't give us the percentage of that? Then what do how do we do the equation? Like, do we just like automatically do 40-60%?
Yeah. They will give you the percentage for sure because this is the method talking about it. The gross margin percentage. Like, so this, what is the, we have to understand what is 40% coming from. Right? How is coming to 40%? That is total revenue, deduct cost of goods sold. Okay, and then divide total revenue equals to 40%. 40%. So this is the one. This is what is 40% coming from. We have the total revenue, we have cost of goods sold, and then we deduct the divide by total cost, total revenue. That is 40%. What's that 60%? 60% is cost of goods sold, right? So we estimated 60% of the sales revenue. Now, if we do not give it, if the question just simply give us total revenue and the 40%, you need to do the calculation, which is totally use total revenue. Total revenue deduct 40% times total revenue. And then equals to cost of goods sold, right? If they didn't give you the percentage of cost of goods sold, then how are we going to calculate the cost of goods sold? We use total revenue times 1 minus 40% equals to cost of goods sold. That is the 60% coming from. Because for this question, the examples, right? The total revenue is $100,000. That's why the estimated cost of goods sold is 60,000. Because we simply use 100,000 times the 60%. Why we use this? Because the formula looks like this. If that makes sense.
Yeah. Because I was gonna, I don't know if we can do it now or maybe later, but I was gonna ask if he could use one of the activities questions as an example, because I was like having a hard time trying to figure it out.
Is from one of your assignments there?
It's on, yeah, one of the activities. It's the P6-9B, I believe.
I will have to take a look at that because I don't have
Okay.
the questions on hand, but
Yeah,
I'll have to write down so I can send it over to you. Okay, what's that?
P6-9B. It's on session 8 activity.
Okay, so P6-9B. Okay, I will take a look at the question and then I will send the explanation to you.
Thank you so much.
Okay, yeah, just quickly after this session then.
Yeah.
Okay, perfect. Yeah, so this is kind of the examples from our textbook. So, and also this is what how the 60% of sales revenue coming from. Okay, so because it's based on the gross margin percentage formulas. Now, the last 2 slides is quickly go through a retail method. The retail method is much easier when you compare it to the other one, because it's just, you need to know, you need to calculate a retail ratio, right? And in order to know that retail ratios, you must know both beginning inventory and net purchase at cost, and also the net purchase at selling price. And then you could do the calculation. And the cost of goods available for sale at cost, we then divide it at retail and then do the calculation. So the steps to do that, first of all, we deduct net sales revenue, right? Which is cost of goods sold at selling price from the cost available for sale. Now we have to know 2 different numbers. First of all, we need to do the numbers at cost, which is beginning inventory at cost and beginning inventory at selling price. We need to know the total purchase at cost and total purchase at selling price. Then we could calculate the goods available for sale at costs and also the goods available for sale at selling price. Then the total selling price and net sales, the $696,000, it has to be given. So we need to do the calculation, then we can do the calculation for retail ratio, which is simply use goods available for sale at cost divided by the cost available for sale at selling price. Then that is 70%. That is the estimated ending inventory at the retail method. we use the 70% retail ratio times the ending inventory at selling price. That is the physical count. It's very rare used, this method, because as you know, there's just too much information needed when you do the calculation. So yeah, just quickly go through this so you know. The only thing you need to focus on is the tablet. Okay, is coming from the beginning inventory to the ending inventory. What you need to do the calculation. We use beginning inventory purchase for purchase plus the purchase. Then that equals our goods available for sale. Okay. Then we know that, then we could do the calculation to the estimated ending inventory at cost. So that is the whole thing you need to pay attention on. Now, that is actually for chapter 6. I will send that problem 6-9B because I have to take a look at the question first. And then we can send it over to, what I can do is, I'll send you by email then. Or I can post it into the discussion forum. Then maybe someone else will have the similar questions. So I'll just post it into the discussion forum in our campus. So every one of you can take a look at that. Okay. And after the chapter 6, what I want to do right now is we're going to quickly go through the final exam. You can try your final, because I already opened the final exam to everyone. So you could do whenever you're ready. Just keep in mind for the final exam, you have 2 attempts. Right? You have to wait till 48 hours for the second attempt. And the policies were saying that if you already passed the first attempt, you're not allowed for the second attempt. So just keep in mind on that. Now the final exam will have 20 multiple choices questions, then 10 true or false questions. Then we have 5 different short answers. I have a question from the students saying that they spend a lot of time doing their assignments, right? Probably a couple of hours on that. So they're wondering if there is enough time for them to do a final exam. Just relax, because the final exam is not that hard as your assignments. Assignments is kind of a little bit harder because it's help you to expand your knowledge on the ones you learned from the textbook. The final exam is easier, and there's not that many steps on each question, so you are not going to spend that much time. So first of all, first question you need to pay attention is, how are you going to prepare a journal entry to record business transactions? That is the one we learned from chapter 1 and 2, right? For examples, how are you going to record a journal entry if the owner invested in business? Okay, that's chapter 1 and 2 question. How are you going to record a journal entry if the owner purchased the office equipment and supplies on the account? Okay, your debit, office supplies, credit, accounts payable, right? And how are you going to record a journal entry to receive cash from one of the services provided? Right? Your debit or cash, credit, service revenue. And yeah, so those kind of questions. What else? For example, for prepaid insurance, okay, we spend cash and paid prepaid insurance. We just remember prepaid insurance, we treat it as asset. Okay, so we debit, prepaid insurance, credit, cash. Also pay attention to those special journals like prepaid insurance one, and they're also what else? Salary payable. Okay, those are the adjusted entries you need to do at end of each month. So pay attention to those kind of business transactions that you surely understand how you're going to prepare journal entries based on the business transaction. Now, question number 2 is coming from your chapter 3, that you need to prepare adjusting entries. I have received questions from students that saying that adjusting entries they don't know how are they going to do the just adjusting entries and what kind of entries they need to do. The adjusting entries always just fall in 5 different categories, remember? And it's always been down at end of the period. So they will show you there's adjusting entries you need to do. They will tell you. So be careful when you need to do adjusting entries. We do insurance expenses. If there's a prepaid insurance, we always do amortizations, right, for any capital assets. We use straight-line amortization method. So just simply use the total historical cost divided by the valuable year. Then we have a salary payable, salary expenses, right? We recognize the salary expenses, we credit a salary payable. And then if there's unearned revenue, we realize the unearned revenue and credit the revenue earned. So that is the one. And also, I think you have down a chapter 3 activity from the Pearson. They give you one adjusted trail balance or give you unadjusted trail balance and adjusted trail balance, ask you to do a adjusting entries. So that is kind of the question format you will see. Just be careful and looking for those special journals, then you should be fine. Now, question number 3 for the short answers, they give you adjusted trail balance and wants you to do a balance sheet. So if you see that question, just make sure that you know how the balance sheet looks like. You always start with assets. You calculate your total assets and then calculate the liability. So assets always equal to liabilities plus the owner's equity. So always make sure the equation is balanced when you finish your balance sheets. This balance sheet is not the ones that you feel you're going to spend a couple of hours on it. It's a very short one. For example, the assets always start with like cash, right? Account receivable, right? If there's a prepaid insurance, it's always under assets, prepaid insurance, prepaid rent, or if there's office supplies, those are all under assets. Then pay attention to owner's equity, because sometimes you need to do the calculation. They probably give you the beginning balance of the capital, and then you need to know the net assets, or if there's a net loss, you need to deduct it, right? And then you need to deduct the withdrawal, okay? Or you need to add in the investment. So just pay attention on how to calculate the owner's equity, the ending balance. You need that ending balance because you have to do a ratio analysis. So after you finish your balance sheets, make sure you understand how to do a current ratio and how to do a current ratio. It's very important. We use your current assets divided by current liability. Okay, so that is the current ratio. Current assets divided by current liability. Now, any question? Just make sure when you do your balance sheets, make it balanced, okay? But if you tried your best, but still cannot balance, but do not freak out. Just keep doing that and just keep doing and finish the question. You do not leave it on blank, because if you leave for blank, you get nothing. But if the finals it doesn't balanced, it still get some of a point. Right? That question I think is worth like 20 marks. Yeah, 20 marks. Now the last 2 questions. So the number 4 questions is for your chapter 5. It's for the perpetual journal inventory system. How are you going to make a journal entries? If there is a sales return, if there's a discount applied, how are you going to do a journal entry on that? We've been talking about that a lot because you need to purchase. You have your account payable as debit, right? And then if there's a discount, you credit the inventory, right? And then credit cash. Okay. So make sure that you understand how you do a discount apply for inventory. Then number 5, those are all just 2 or 3 journal entries, and that's it. They're not asking for a 10 or 20 journal entries on that. Now, the last question, make sure you understand how to do a closing journal entry preparation. Closing journal entry. we close revenue to income summary. We close expenses to income summary. Then we close income summary to capital. And then the last step, we close the withdrawal to capital. That's it. Okay. So that is all for the final exam. If you're ready, then you could definitely try it tomorrow. Then you wait for 48 hours on Sunday, and then you have a second attempt. But as I said at the very beginning of the course, the 2 different attempts will give you a different questions. You are not going to see the same, exactly same question for the second attempt. Okay, sometimes it's harder, sometimes it's easier. It's just randomly picked by the system. So, but you should be fine. It's as long as you focus on the topic I just gave to you, you should be totally okay. Now, any questions? No? Good? Abigail? No?
I had a question. I forgot about it. I'm so sorry.
Yeah, sure. Go ahead.
I have to remember it. I totally forgot about it.
Oh, that's okay.
Sorry.
Yeah, you could definitely send me an email or talk to me in the team because I'm gonna be there for a while. And then I'll take a look at that questions you have, and then I'll post it into that discussion forum. So you could definitely go take a look at it. So just in case someone else will have the same question. So if I post it in there and everybody can take a look at that. Okay, so that actually for today. Yeah, as I said, if you have questions, just send me information or email me or chat and team work for me. Thanks for coming. I'm gonna stop recording now.